Chakri, it's interesting that some of these consumption, pure play FMCG names as well are seeing that bit of sell-off in the last 2 days or so. Do you think it's time to maybe take some profits off the table when it comes to FMCG? Because this has been looked at as one dream sector, so to speak, almost being called defensive as well, start of the year.
You know, in the case of FMCG, the valuations have always been fairly high and the stocks have done very well in most cases. And so from that perspective, I would not be a seller simply because of valuation, because we are going into the festive season. You have Dashera, Diwali, Christmas, all kinds of stuff coming up in the coming months, which will keep the stocks consumption levels fairly high. So I would in fact use the weakness to add into some of these defensive names, because FMCG will continue to at least deliver on earnings, which is whereas in some other sectors you have a risk to earnings, which is not here in FMCG.
71.47 on the rupee right now. This is getting a little alarming because it's not just a breach of 71. We are, very swiftly getting to 71.50, who knows, 72 or even 73 kind of levels in the currency. And mind you, when rupee started off trade today, you saw just marginal bit of strength even during today's intraday session as well. About 12 o'clock or so, you did see the rupee actually recover from its morning losses, and now you're seeing some steep decline to the tune of about almost 26 paise building in for the rupee. Chakri, where else are you identifying opportunity where you think you could be a buyer in this current decline aside of FMCG, which you just highlighted?
You know, I would continue to look at all export-related sectors, which is IT is a clear winner. Pharma is again coming out of this FDA issues, plus a strong demand in the US. So I'd be a buyer of pharma. Export-related sectors, metals is an export-dependent sector. And, in spite of the volatility, all steel, copper, zinc, aluminum, all these prices are still moving high. Whereas the stock prices, if you look at Tata Steel or Hindalco, year to date, they have underperformed the Nifty. Nifty is up about 10-odd%. Each of these stocks is down about 10-odd%. So I think there is a lot of catching up to do, and their valuations are very reasonable at that. So I would be a buyer of metals, and I'd also be a buyer of companies in textiles and chemicals, which have a big export component.
All right, Chakri, just stay on with us. Let's. Chakri, I just have a question very quickly on also some of these banking names. A lot of people have been saying that, up until now, the flavor of the season was private banks, safer, more room for them to grow, more room for them to even acquire market share from the public sector banks who have their own problems at this point of time to grapple with. But slowly, we are seeing a lot of interest come by even in some of these public sector banks, because they are saying that, the asset quality problems have bottomed out. The worst is perhaps behind them. We're seeing better and slightly more efficient resolution as well of some of these IBC related cases. So do you think there's a case for PSU banks at this point?
I think probably the power sector resolution will be the last shoe to drop for the PSU banks, and against that backdrop, SBI, State Bank of India, is well placed. It's not losing market share. It will continue to gain market share against the other weaker PSU banks. But in general, yes, those guys with a lack of capital, because after all these NPAs are done away with, they have to go and raise capital for growth, and that is so the lack of ability to raise capital of growth, or rather the restriction because valuations are low, the government won't let them to do QIP, and lack of capital makes them lose market share. So I think against this circle, the private banks are gaining some market share, and so are NBFCs.
Yeah, Chakri, stay with us. Lots to talk about. But
Chakri is back with us. Chakri, my question to you was related to asset allocation, and points which I was putting forward is that valuations are at a decade high. We have crude and currency not in our favor. We have some of the AAA rated debt instrument offering around 9.5% return. Why one should invest in equity according to you with this kind of risk reward ratio?
Oh, that's a good question, but I'm a die-hard equity person, so I'd still say equity. But if you look back at over the last any number of years, Take the last 5 years, not particularly a great economic environment, but or even the 10 years. The CAGR has been for equities is about 14-15%, whereas for fixed income it is far lower, it's about 8%. And mind you, after tax rates are higher. It's your marginal tax rate for in the case of fixed income versus equities, at least as of now, it's 15% and 10% capital gains tax. So in terms of risk reward, still equities offer the highest post-tax returns if you look at the last 5 years or 10 years, and there's no reason to believe that it won't continue to the future.
Right. Okay. Just mapping what else is going on in the market. IRB, and we were chatting with the IRB management, Chakri, earlier today. I don't think their comments on the fact that they actually foresee a slowdown in road activity in the run-up to the elections have gone down well with the market.
Yes, I think if anything else, road activity will actually kind of pick up at some point closer to the elections, because it creates a lot of immediate jobs. So from that perspective, the road companies, while the companies have not, the stock prices have not done well. And yes, NHAI awarding has slowed down, but I think we will see a pickup in road activity, and that's a space which still looks strong enough in the infra space.
Hey, Chakri, thanks for joining us.